Hey folks, imagine this. Gold just plunged 11% in a single day, marking its worst single-session drop since the 1980s, only to surge back over $5,000 per ounce within days. Silver collapsed over 30% in that same session, wiping out gains that took months to build. Now ask yourself honestly, is this kind of volatility your biggest fear right now? Or is it actually the opportunity of 2026 that everyone will look back on and wish they had acted upon? Stick with me through this entire video because I'm going to show you exactly why gold could realistically hit $6,000 this year. And more importantly, how you can position yourself to potentially benefit from what's coming next. Look, if you're like most investors in the United States or Europe right now, the markets feel genuinely scary. I'm not going to sugarcoat it for you. Gold's wild ride over the past few weeks is just one piece of a much larger puzzle that's keeping serious investors up at night. That crash in late January wasn't some random market hiccup. It wiped out billions of dollars in value as traders panicked over Federal Reserve signals, a suddenly stronger dollar, and uncertainty about where monetary policy is actually heading. But gold isn't suffering alone in this environment. Tech stocks are experiencing what some analysts are calling a legitimate freefall, with artificial intelligence disrupting everything from software companies to traditional service businesses. We've seen nearly $1 trillion in market capitalization evaporate from the technology sector as investors reassess valuations in a world where AI can automate tasks that previously required expensive human talent. Software giants that seemed untouchable just months ago are watching their stock prices crater as the market digests what this technological shift actually means for their business models. And globally, the situation isn't any calmer. Tariffs and trade tensions are adding fuel to an already burning fire. Policy shifts seem to come out of nowhere, reshaping trade relationships that took decades to build. This fear you're feeling right now is completely real and completely valid. Is the kind of fear that keeps serious investors awake at night staring at portfolio screens, wondering if their hard-earned money is actually safe, or if we're heading into the kind of choppy waters that can sink retirement plans and financial goals. You're probably sitting there thinking the same thing millions of other investors are thinking right now. How do I actually protect my money when literally everything feels so unpredictable? That's the fear gripping markets from Wall Street to Main Street. Uncertainty from policy shifts that seem to change weekly, AI disruptions that are rewriting the rules of entire industries, and genuine economic slowdown risks that even the optimists can't ignore anymore. JPMorgan is currently putting a 35% probability on a United States recession hitting this year, which could drag down virtually every asset class if it materializes. That's not some fringe prediction from a permabear. That's one of the largest and most respected financial institutions in the world, saying there's roughly a 1 in 3 chance the economy contracts significantly. But here's where the story gets genuinely interesting, and this is why I wanted you to stick around. Gold isn't just surviving this chaos. It's rebounding stronger than almost anyone expected, and that rebound is telling us something important about where this market is actually heading. Let me dig into the chaos with you so you understand exactly what happened and why it matters for your money. That gold crash everyone is still talking about didn't happen in a vacuum. It occurred amid President Trump's nomination of Kevin Warsh as the next Federal Reserve Chair. Warsh is widely viewed as a monetary policy hawk, someone who prioritizes fighting inflation over supporting asset prices. The market interpreted his nomination as a signal that interest rates might stay higher for longer than previously expected, which pushed up Treasury yields and strengthened the dollar significantly. When the dollar strengthens, it becomes more expensive for international buyers to purchase gold, which is priced in dollars globally. This dynamic hammered precious metals hard. Gold dropped from highs near $5,600 per ounce down to around $4,800 in what felt like a flash. Silver got absolutely destroyed, tanking 30 to 36% in a single session. That kind of move hadn't happened since the Hunt brothers' silver corner collapsed in 1980. We're talking about historic generational volatility that caught even experienced traders completely off guard. But then something remarkable happened. By early February, gold started rebounding sharply. We saw gains of 2.7% in a single session, pushing prices back to $5,071 on February 4th. By February 6th, prices had stabilized around $4,954, supported by a weakening dollar and fresh geopolitical tensions between the United States and Iran. The market was telling us that the fundamental case for gold hadn't actually changed. It had just been temporarily overwhelmed by the Warsh nomination shock. Now, let me layer on the latest news that's shaping this market right now. The United States just slashed tariffs on India from 50% down to 18% as part of a larger deal. Under this agreement, India stops purchasing Russian oil and shifts its energy imports to American and Venezuelan supplies instead. This kind of deal has massive implications. It could ease some of the global trade pressures that have been weighing on emerging markets, and it indirectly supports gold by reducing some geopolitical risks while simultaneously creating new uncertainties that keep safe haven demand elevated. But the news isn't all positive for every sector. Technology is getting absolutely crushed right now. Software stocks that were market darlings just months ago are experiencing devastating sell-offs. Salesforce is down 26% year-to-date. Intuit dropped 11% in a single day. The reason? Artificial intelligence tools from companies like Anthropic are automating jobs and disrupting business models that Wall Street assumed were safe. Investors are fleeing technology positions and genuinely debating whether AI represents an existential threat to traditional tech valuations. Some analysts are calling this the biggest structural shift in the technology sector since the dot-com bust. Let me share what the top traders and institutions are actually saying about this environment. Goldman Sachs released their tectonic outlook for 2026, and while they see a broadening bull market with global equities potentially up 13% in price and 15% including dividends, they're warning loudly about AI shaking up valuations in ways that are difficult to predict. Their message is essentially that the easy money in tech has been made, and navigating this sector now requires much more careful analysis. JPMorgan's 35% recession probability highlights how sticky inflation and policy risks are keeping volatility elevated across all asset classes. Their economists are pointing to labor market data, credit conditions, and consumer spending patterns that suggest the economy is more fragile than headline numbers indicate. This agitation and uncertainty is exactly why so many investors are sitting on cash right now, paralyzed by fear and missing rebounds like gold's recent 3.9 to 8% jumps. While they wait for perfect clarity that will never come, opportunities are passing them by. But here's the thing, you don't have to be one of those paralyzed investors. This is exactly where gold shines as your solution in this chaotic environment. Let me explain why that massive rebound happened and why smart money is positioning for much higher prices. The fundamentals supporting gold are absolutely rock solid right now. Central banks around the world are buying gold at an unprecedented pace. JPMorgan expects global central bank purchases to hit approximately 800 tons in 2026 as countries actively diversify away from dollar-denominated assets. This isn't speculation. This is documented buying that shows up in official reserve data month after month. Safe haven demand continues surging as geopolitical tensions remain elevated. The United States-Iran relationship remains tense despite occasional diplomatic overtures. Trade deals are reshaping global commerce flows in ways that create both winners and losers. Europe faces its own set of challenges. The Middle East remains a powder keg. All of this uncertainty drives capital toward assets that have preserved wealth for thousands of years. Additionally, as technology sells off and recession fears linger in the background, money is rotating into real assets like gold that offer protection against multiple scenarios. Whether we get inflation, deflation, recession, or stagflation, gold has historically performed well in uncertain environments. The expert consensus is remarkably bullish when you look at the actual price targets from major institutions. JPMorgan forecasts gold reaching $6,300 by the end of 2026. UBS is projecting $6,200. Deutsche Bank and Societe Generale are both calling for $6,000. Goldman Sachs is somewhat more conservative at $5,400, but they acknowledge upside risks from potential rate cuts and renewed ETF inflows. Bank of America is calling for $6,000 in the near term, suggesting we could see that level sooner than many expect. Let me give you an actionable strategy you can actually implement. First, consider buying on dips. Gold is currently trading around $4,900 to $5,000. If volatility creates another pullback, aim for entries below $5,000, where risk-reward becomes even more attractive. Second, use exchange-traded funds for easy exposure. Products like GLD or IAU give you gold exposure without the hassle of physical storage, insurance, or security concerns. These are highly liquid instruments that trade on major exchanges and can be bought or sold in seconds. Third, consider allocating 5 to 10% of your portfolio to gold as a hedge against technology crashes and recession risks. This isn't about betting everything on gold. It's about diversifying intelligently so your portfolio can weather multiple scenarios. Fourth, watch the catalysts carefully. Federal Reserve rate cuts are expected sometime in the first or second quarter. Additional central bank purchases will be reported throughout the year. Tariff impacts could boost emerging market demand for gold as a neutral store of value. Fifth, set realistic targets for yourself. Consider taking partial profits around $5,500 to lock in gains, then hold remaining positions for the $6,000 target if momentum continues building. This isn't gambling or speculation. This is smart positioning in a world where artificial intelligence is disrupting technology valuations. Tariffs are reshaping global trade, and recession odds sit at 35% according to major institutions. Gold serves as your reliable anchor in this storm, an asset that has preserved wealth through wars, depressions, inflations, and every other crisis humanity has faced over thousands of years. The investors who will look back on 2026 with satisfaction are the ones who recognize this moment for what it actually is, not a time to panic, but a time to position thoughtfully for what comes next. The volatility that's scaring everyone else is creating the exact entry points that build long-term wealth. So if you're ready to turn market fear into genuine opportunity, I need you to do a few things right now. Hit that like button if this breakdown helped you understand what's really happening in the gold market. Subscribe to this channel for more no-hype market insights that cut through the noise and give you actionable information you can actually use. Drop your gold price prediction for 2026 in the comments below. Do you think we hit $6,000? Do you think we go even higher? I want to hear your thoughts and I read every single comment. Turn on notifications so you don't miss the next market update or rebound alert. In this kind of volatile environment, timing matters, and I don't want you missing critical information because the algorithm didn't show you my video. Thanks for watching, thanks for being part of this community, and let's make 2026 your best investing year yet. I'll see you in the next one.